Hello, everyone. So in this video, we're going to talk about the risk-adjusted return. We're going to talk about why do we need to have a risk-adjusted return and what are the common metrics that combine these two angles. So first, let's talk about what is a return. So typically we use this letter R to represent that this is a return. Okay, a minute. So we use this letter R to represent that this is a return and this is a random variable, right? So which means that it is random, it is uncertain. Now, since this is uncertain, and we typically assume that it follows a certain distribution. Okay, so for example, if we draw out a curve, which is the stock return in the history, so this could be like this, right? So itself is random, and every day it could take on different values. But typically, when we analyze this asset, looking at the returns and the time series, we would like to have some summary statistic, right? So some single number to summarize, to capture, and to characterize this particular asset. So what are the instruments? We would typically use the mean, right? So what is the mean return and what is the volatility or variance? So most commonly would be the variance. Okay, so given a particular time series, for example, this could be past 100 days returns, we would calculate the mean and calculate the variance. So the mean would typically use the mu, and then it's easy to calculate. For example, we have n days of returns, and then it would be adding up all the n days from day one to day n, all the days return, and then divide it by n. So this is the definition of mean return, and this is how we calculate it. For variance, typically we use sigma square, and as usual, by definition, this variance is the deviation. So what is the deviation? Every day I'm going to deviate from the mean, right? But because deviation has up deviation and downward deviation, so we would square it, and then we to take the average. So this is summing up and then 1 over n. Okay, so this I goes from 1 to n. Now these two numbers are essentially the summary statistics, or in more 101 traditional statistics, these are called the first two moments. Okay, so the first two moments. And now basically when we talk about an asset, we can just use these two numbers. So what is the average return and how risky, how high is the variance for this particular asset? And then we can use these two numbers to compare all the assets. Okay, so let's say that if we draw the mean and variance, so say this is the variance and this is the mean, right? And then we can uniquely plot out each and every asset on this graph. So maybe this is a low return, low volatility, and high return, high volatility. Okay. So the next question is how do we invest? Right. So which one do we invest in? Now, typically, this is a difficult question because we have two objectives. So we want to maximize, the higher the better, but the variance we want to minimize, the lower the better. But both angles, they are sort of single objective. So when it is single objective, it's easy to use the tools and find the one, just sort and then take the highest return or lowest risk. But in this case, in reality, we have multiple angles, we have multiple objectives. So this falls into a field called multi-objective optimization. And this is a big field. We're not going to go there. And typically, this is also more complex. So for a normal person, it is much more intuitive to still come back, right? So still have some way to combine these two metrics and then come back to a single number. Okay, so we would like to have a single metric that allows us to sort, to rank different assets, and then choose the one with the highest value for this single metric. Okay, and this single metric needs to have the properties that the higher the better in terms of return, and the lower the better in terms of risk or variance, right? And so that's the main motivation why we would like to combine them, because it's not easy to do optimization at two fronts, right? Two different metrics. We would like to have single metric that captures both return and risk. And that is why we have the risk adjusted return. All right, risk adjusted return. Okay, so there are three common metrics that are commonly used to combine risk and return. So the first and foremost, or one of the most widely used one would be the Sharpe ratio. Okay, so the Sharpe ratio is intuitive. So when you look at return and when you look at the variance, the most intuitive way would be, oh, let's just take the ratio of these two, right? Take the ratio of these two. And that's fine. But typically, when you invest in the financial market, there is something called risk-free interest rate. Okay? Risk-free interest rate. So this risk-free interest rate can be thought of as, for example, if you save your money or buy some in the bank or buy some treasury bills, these are considered very low risk instruments. So basically, you're guaranteed to get the return, right? And then this is a benchmark. So so the asset we are looking at needs to outperform the benchmark, right? So we have a comparison, we have a benchmark. So we denote this risk-free interest rate would be RF. Okay, so risk-free interest rate. And now, once we take the difference between the current mean return we have and the risk-free interest rate, this portion is called the excess return. Okay, excess return. So which is the return in excess of the baseline. Okay? Of course, we need to have some benchmarks so that we know how we are doing compared with just investing in the safest asset. All right, so that's the definition of Sharpe ratio. So basically, Sharpe ratio is defined as the ratio between the excess return and the variance of the asset. So more technically, this is actually should be the standard deviation, but that's the same thing. Okay, so just to say that what is the excess return per unit risk. So risk is volatility, volatility is the standard deviation, right? So basically, we are looking at a metric. That's to say that, oh, let me unify all the assets in terms of unit risk and look at which one has the highest excess return on top of the risk-free interest rate. All right, so that's a commonly used metric for combining risk and return. So the next question is that, oh, what are the good values for Sharpe ratio? Okay, so Sharpe ratio, of course, it'd be good to be positive, right? If it's negative, then we are doing worse than the risk-free interest rate, which is not good. Okay, so now that is, but how high could it be, right? So typically, if it's the Sharpe ratio SR, if it's above 0 and less than 1, this is considered okay. Okay, so it's not too bad, but also not too good, right? So if it's in between 1 and 2, that is typically considered as very good already. Okay, so or good to some extent, right? And typically we will see this in this range for a good strategy. And for Sharpe ratio above 2, this is phenomenal. This is excellent, right? But you need to be careful that is the strategy with Sharpe ratio more than 2, is it really consistent, right? So that's why back testing is very important. So even if you see above 2 in terms of Sharpe ratio, it may be that just for that particular period of time or just for that particular asset. So really a good strategy is to be able to deliver good performance in different markets and different regimes. All right. And now let's look at what are the limitations. So limitation would be again how do we measure risk? Okay, so risk so far we have been using variance. Okay, variance to measure risk. However, that is not necessarily true or not necessarily suitable for everyone. Okay, so what is variance? Variance is we have the mean, mu, and I would deviate from the mean. So all these deviations are my variance. Okay, so this is for example, variance is very high. So this is variance. It's very high. And for another scenario, maybe this deviation, and this is a variance for the portfolio. This is very low variance. Okay. Now the limitation would be exactly if you look at just the positive part. So this positive and this negative, right? Above mean and below mean. Now positive deviation is good. So this is good, right? We like it because the higher the better in terms of the return itself. However, this is bad. The bottom deviation is bad. The downward deviation is bad. And the reason is because it represents a loss for us. Okay, so it represents a loss. And this is a profit. All right. So it seems that we have so our preference for upside deviation and downside deviation is not symmetric, right? It's not symmetric. However, if you look at the definition of variance in the previous slide, this is treating both upside and downside deviation symmetric. Okay, so no matter either it's up or down, once you square everything, right? Once you square everything, it becomes all positive, and there's no differentiation of the sign or the direction of this derivation. Okay, so and therefore, people have invented different ways to capture this downside risk. So this is what we call downside risk. All right, and that's leads to the other two risk-adjusted returns as well illustrate now. Okay, so first would be the Sortino ratio. So we would just take the return for the portfolio, and let me just use the expected return with mu of the portfolio, and then minus the risk-free interest rate, right? And then divided by the standard deviation, right? Still it is a standard deviation, but it's the downside standard deviation. So what does that mean? That means that for all the fluctuations, right? So we have fluctuations here, and then will be here, and then here, and then here, right? So assume this is our return time series, right? So I will just look at the bottom, okay, because it is downward risk interesting. And then take this each point and then still apply the same variance formula and then calculate this standard deviation for the downside. Okay, so still it's the same formula. It's just that we are ignoring all these bottom the up deviations and just focusing on the bottom deviations. All right, so that is the Sortino ratio. Okay, so essentially, we avoid penalizing the upside volatility and we just focus on the downside volatility. All right. So therefore, the interpretation would be the per unit downside risk. Okay? Per unit downside risk. How is our excess return? So this excess return. All right. So this is very much important and relevant metric for those risk-averse investors. Okay, so risk-averse. So essentially, it represents the downside risk. It does not represent the upside. So there's no reflection in terms of how high your potential return can be. All right. So that's the one variation, which is Sortino ratio. There's one more, which is the Treynor ratio. So Treynor ratio is still using the same thing. So we use the portfolio return minus the risk-free interest rate to get the excess return. And we divide it by this beta M. Okay, so M stands for the market. This is the market. And beta M is the, so this is essentially the how sensitive is our portfolio to the overall market. So it represents the sensitivity to market. Okay, sensitive to market. So what does that mean? That means that if the overall market changes, then how will our portfolio change? So how sensitive, how sort of correlated our portfolio is to the market, right? So why this is important, and that's because it comes from the motivation that's or the theory of asset pricing model. So what is asset pricing model? It essentially says that if market is in equilibrium, right? Equilibrium. So supply demand, they are in equilibrium, and then there's no arbitrage, etc. We would see that the return. So the return is our RP. So RP stands for the return for our portfolio. Okay, minus the risk-free interest rate. So this is excess return, right? And then it's equal to a market portfolio. So this is portfolio return for the market's portfolio. So market portfolio. So this is a market portfolio. Is essentially you can think of it as a S&P 500. Okay? So if we invest in S&P 500, then we will have a market portfolio because essentially you are investing across the whole market, right? 500 stocks, but also it essentially covers the whole market, and then you will get a return based on this index. Okay, so this is the market portfolio, and then you minus the risk-free interest rate still. So we have two paths to compare with each other. So if we run linear regression, we will get a coefficient which is beta m. So this is where beta m comes in. Okay, so this is where beta m comes in. So essentially, this measures the sensitivity of the excess return of our portfolio to the excess return of the market portfolio. So sometimes we call it this is a market factor, right? This is a market factor. And then this measures the sensitivity of our portfolio to the market portfolio, and then this is sometimes called the factor loading. Okay, factor loading. So it's just a number. It could be 0.1, could be 1.2. It essentially refers to the sensitivity of our portfolio to the overall market, right? To the overall market. So what does this mean? So if beta m is very big, so if this beta m is big, right? It means that our portfolio is very sensitive to the market, and that means that no matter how we diversify, it's not going to help, right? Because if the whole market goes down, then we cannot diversify anyway. Okay, so if the beta m is big, then our Treynor ratio will be very small. Okay, so going down is very small. So which means that it's actually very impacted, very much impacted by the sensitivity to the market, right? So essentially, it gives us an indicator of the performance relative to the market risk. So this again, another angle to look at is this is represents our market risk or per unit market risk. What is our excess return? Right. So this is generally a good metric if you want to benchmark against the broader market, right? So see how your portfolio performs. All right, so that's pretty much about it for this video, and thanks for watching.